Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor. I'm speaking to you from New York City on this, the 12th day of May, 2020. Before I talk more about today's show, I do like to remind you I write a newsletter. It's a weekly and a monthly letter. It's called Turning Hard Times. Actually, that's the name of my show, isn't it? Jay Taylor's Gold, Energy, and Tech Stocks is the name of my newsletter, and I put it out every week, and it's a lot more fun these days because the things that I'm writing about are doing much better. The gold shares are doing very nicely indeed, and a lot of great discoveries being made by these little junior companies. Life is very exciting in this sector for sure. Would also like to encourage you to consider signing up for Chen Lin's letter. What is Chen buying? What is Chen selling? Go to chenpicks.com. In addition to the mining and energy sector, of course, is another story these days. But Chen is doing very well in the biotech sector. That's one of his specialties. So you might, if that's of interest, you might want to check out Chen's work. And, of course, Michael Oliver's work, his excellent proprietary technical work. And Michael is with us in just a few seconds from now. OliverMSA.com is where you need to go to sign up for Michael's work. And, of course, we want to thank you all for listening to the show, making it one of the more frequently listened to shows at the Voice America Business Channel. And also like to encourage you to send along whatever thoughts you might have about our show to questionsfortaylor@gmail.com. And, of course, we must thank our sponsors because without them there would be no show. Today's sponsors are RN Resources, Ely Gold Royalties, Great Bear Resources, Hannon Metals, Irving Resources, Novo Resources, and Citco Gold Corp. Before I talk about today's show, I have a couple of announcements that I'd like to make. First, Great Bear Resources reported some very, very exciting news yesterday on its Dixie project in the Red Lake District of Ontario. It drilled the deepest hole yet, and that intersected the Dixie Limb and Dixie Hinge high-grade zones, which were the first zones discovered on the project a couple of years back. Drill hole 85 intersected over 19 grams of gold over 19 meters, or about true width of 15 meters. Very good mining width, of course. That same hole also intersected 25.5 grams over a half a meter in the Dixie Hinge zones. Now, it seems likely, very possible anyway, very possible that all three zones discovered to date, that is, the very large-scale LP fault, the Dixie Limb, and the Dixie Hinge, may all coalesce at depth. And if that's the case, then this stock has much, much further to run, I must say. The Dixie Limb zone is now extended to a depth of 740 meters below surface, and the Dixie Hinge 840 meters below surface. Now you start to look at a strike length of over 5 meters. At those kind of depths and widths, we're talking about potentially some very large-scale gold mineralization, a multi-million-ounce gold deposit. So this is certainly one of the most exciting stories that I've covered in a while. Chris Taylor will be with me in several weeks from now to update us on Great Bear. The second announcement I want to make is that I will be participating on the Virtual Metals Investor Forum taking place in a couple of days from now, May 14th, starting at 9:30 Pacific time or 12:30 New York time. My segment will begin at 12 noon Pacific or 3 o'clock New York time. And the companies that I've invited to be a part of my segment, Calibre Mining, Gold Source Mines, Klondike Gold Corp, Rise Gold Corp, and Premier Gold Mines. My segment will begin, as I say, at 3 p.m. New York time, and I will provide my own thoughts about the markets then. And then following that will be 10-minute presentations from those companies I just mentioned. Gwen Preston will be starting that event at 12 noon New York time, and Brian London will round out the show starting at 5:30 New York time. That's Thursday. And you can go to jtaylormedia.com, click on the Metals Investor Forum banner there to sign up for this event. It's free of charge, but you do need to sign up to gain access to this virtual event on your computer. So I hope that you'll join me there. I've titled today's show, Will COVID-19 Lead to a Gold Standard? Well, that was after an essay written by Alistair MacLeod a few weeks ago. Alistair, Axel Merck is joining me today, and Michael Oliver, or my guest this week. In 2004, Dr. Stephen Roach at Morgan Stanley warned that America was on a collision course as it borrowed excessively from China and Japan to fund its treasury. The collision course that Dr. Roach warned about in 2004 arrived, in my view, only on September of last year, when the repo market interest rates exploded to 10%, revealing what I believe is a bankrupt America. Relating to that event early this year, Alistair was warning of an impending collapse of the existing dollar-centric fiat currency system. And then in the very first quarter of this year, COVID-19 pays the United States a visit, and instantly the largest part of our economy is triggered into what many believe is emerging into a depression. Certainly a downturn very much like, or perhaps even worse, God forbid, that of the 1930s. For reasons I expect to talk to Alistair about, there will almost certainly be a currency reset in the near future. At least that's what he believes. But will gold be a part of that new system, or will we inherit something even worse, or something very much worse than what we have now, say a digital-based monetary system that can be used by government to completely remove our constitutional rights that we Americans have enjoyed for so many decades? In any event, how will gold perform during this impending depression? It was a financial savior for those who owned gold during the 1930s, thinking about companies like Homestake Mines that went up ninefold while the Dow Jones lost 90% of its value. But how might those gold mining shares or gold itself operate or perform if we're heading into that kind of a decline now, especially if it's this time it could be a hyperinflation instead of a deflationary depression? So those are some of the things we want to ask Alistair about. In recent days, there have been reports of increasing difficulty in securing physical gold by larger investors when they choose to take physical delivery of gold when they liquidate their futures contract. Well, it's difficult for smaller investors who wish to take delivery of physical gold. That is a question we want to ask Axel Merk about his company and what he's providing. He has an ETF named the Van Eck Merk Gold Trust, and you can simply buy shares in ounce in that trust, OUNZ, trades on the New York Exchange, and you can take delivery of gold behind those ETF shares. You sell the shares and get paid in gold instead of fiat money. So Axel Merk will be with me right after the first commercial break to talk about that product. But right now, I'm really pleased to tell you that Michael Oliver is with me once again. Thanks for joining me again, Michael.
Good to be back, Jay.
Always good to be back. And, I should tell our listeners that I like to contact you in the morning of our show and say, what would you like to talk about, Michael? And then let you decide what you want to talk about, because, frankly, you're looking at a myriad of all kinds of markets, and you have a better sense than many, I think, of how they fit together, how one sector impacts another. So that's why I like to ask you that. And you told me today that for sure you want to talk about the banks, the banking sector. So go ahead, tell us why you're concerned about the banking sector.
Well, the banking sector, of course, we know collapsed, and it was the scapegoat of the 2008-2009 collapse and the mortgage-backed securities and stuff like that. And it was financial. Okay, that was where the focus was. And during that time, actually, the banks, on a spread basis. Now, what is a spread? A spread is a measurement of, let's say, a banking index, banking ETF, measured as a percent of the price level of the S&P. So, it's at a given percent, and if it drops in its percent value relative to the S&P, even if price is going up, but the value drops, the spread is dropping, meaning the valuation of the banks relative to the broad market is dropping. Well, we had a collapse not only in price in banks in 2008, 2009, but in the relative performance. And what's interesting is while the market turned around in 2009 and went up, and the banks also turned up on their price charts, their relative performance never turned back up. In other words, it was like a flat tire that stayed flat. So all the valuation, the relative valuation of the banking sector to the broad stock market was deflated in 2008 and never came back on a relative performance basis. And then last year, that spread, if you plot it, and we've plotted it in our reports, moved into all-time new lows versus 2009. So the spread was breaking down well before the virus. Okay, so the banks were anemic from the start on a relative basis, all during that decade-long bull trend. They went up at a lesser rate than the market, and then they decided to go sink into new lows on a spread basis late last year, well before the virus again. So now what's going on there? Well, I think it's fairly obvious. It's an issue of debt, and our debt accumulation looks like the bull market. It's a personal debt, corporate debt, government debt. It's just like a skyscraper. And so that's the underlying fundamental problem. And all the virus did is prick a little, pull the scab off that and expose it. But many of the factors in play here aren't getting the headlines. It's not talked about much about the banks. In fact, all I've heard about banks over the last few months is reassurance from analysts, government spokesmen, that fortunately this time around the banks were in better shape before this started than they were in 2008 and 9. I beg to differ.
Oh, that's so. I guess maybe there's some ways you could possibly short the banks, I suppose.
Well, that's one thing to do, but the other thing is just to be cognizant of what's going on there. Don't pay attention to the restaurant industry and the hotel industry and Boeing and things like that and the airlines and. Pay attention to the banks, which don't seem to get the headlines. They should be getting the headlines. In fact, if you look overseas to Europe, not only are the banks weak, they're at or below the price lows of 2009, including the largest bank in Europe, which is a British bank, but HSBC, but it's still the biggest bank in Europe. It's at the 2009 lows. And that's like the S&P being at 600 and something. Okay, so what's going on here? It's not isolated to one bank either. So I have a suspicion that at some point here, probably soon, we're going to get a jolt in gold. And the jolt is going to be of the couple $100 variety, and it happens rapidly. Instead of this incremental strong arm up move we've had, we suddenly get a lightning bolt that takes us through the 1920 price high of the year 2011, where we just come in one morning, gold's up $200. I'm expecting that there will be some headline that comes from the sidelines. And one of those sidelined areas that people aren't looking at is the banking area.
Yeah.
And it wouldn't shock me that we come in one morning, there's a headline coming out of Europe or U.S. about some bank, which suddenly jolts investors into reality about, what's going on here.
Yeah, and certainly, I mean, that would cause people to wonder about the security of the existing monetary structure. So that would make a lot of sense. Well, Michael, we're just about out of time. I want to ask you about silver because you're also thinking that silver, you're sort of pounding the table over silver, if I understand you.
Well, if you look at a price chart of silver, there was resistance up above 19. Okay, keep that in mind. And I think it's valid. I think if you get there again, you will not stop. I don't think you'll even pause at it. The issue is getting there. And if you look at the price charts, there was a rally about a month ago that got up above 16, after we had the fake out low. We rallied back over 16 and halted there. It was the underside of several months of prior action, late last year and so forth. So the price chart has sold it there. They backed it off down into the 14s. But last week on our momentum charts, not price, we overcame a major structure on several monthly oscillators at the 1550 and the 1520 level. Of course, silver's now trading around 1570, 1580. So I think if silver gets above that rally high we had in price, 1630 about a month ago, I think you're going to jolt up to 19, and I don't think you're going to stop there. I think you'll break out through that stuff. So I think silver is on edge here of doing what the gold miners have just done, and that is go vertical and take out all the highs of the last 7 years, which is what GDX has done, XAU index. I think silver's on the verge of blowing through that stuff as well. All
right. Just very quickly, Michael, with regard to equities, still bearish. Obviously a big bounce back from the lows, dead cat bounce there, or what?
It's largely front-end loaded with, we know, 5 or 6 internet and tech stocks. Therefore, it's deceptive. Look at the banks instead. Look at the industrial sector instead. Look at a lot of these sectors of the S&P, and you'll see a different picture. We're looking to identify a rollover in the market. We don't think we're going to get a panic in the stock market again. We think the panic has occurred. We crashed, in other words, in the initial phase of the bear market, like 29. But like in 29, once you rolled over again, and it was a 5-month rally, by the way, back then, before you rolled over. It took years, and it was never a crash after that. It was just a bleed.
Yeah.
And I'm suspecting that's what we're in for. It's not an easy decline, but just a constant decline. But we'll try to time the rollover, and right now we're not there yet in terms of defining the rollover.
All right. Well, thank you again, Michael, for your thoughts on some of these key markets. Always refreshing. Well, not always inspiring, and a lot of pain ahead, no doubt. But we want to be as ready as we possibly can be for what's heading our way. So thank you for helping us in that regard, Michael.